All right, well, we're going to go ahead and get started. I want to respect everybody's time who showed up on time. So welcome everybody. Bernadette Trafton here with the Boston Area Real Estate Investors Association. I love the fact that we're able to do Zoom and we can meet virtually. I also hate the fact that we have to do Zoom and we can meet virtually. I much prefer getting together with people and spending time with them and really getting to learn and hear about what their goals are in real estate. So hopefully in the coming year we'll be able to do that a little bit more. I did want to talk a little bit about next month. So this month it's all about hard money and getting your deals. Getting your deals funded through a lender, rehab deals and whatnot. Paul will go over all of the different things that he has. And then next month, we're going to be going virtual again because I haven't heard of anything opening up. So what happens when you have this great deal, but you don't have any funds? Most lenders, and Paul will explain what he does as a lender and what their guidelines are, but most lenders are going to want you to put 10-20% down. They want you to have skin in the game. So what if you find this great deal and you don't have any skin in, you don't have any skin to put in the game? How do you raise capital to be able to do that? So we're going to be talking about raising that kind of capital so that you have money, so that you can bring a deal to someone like Paul and be able to do the deal from start to finish. So that's with Ketan Patel from Mookie Capital. So I'm kind of excited about that event that's coming up. I am not going to talk too much tonight. I am going to introduce Paul Shaughnessy with Renovo Capital. And I've known Paul for a couple of years now, and he has helped a ton of my real estate investors get their deals done. And he is working with Renovo, and they have some great programs, and he's going to talk about some of the things that they've done and how they've been able to help investors get their deals done in situations where they didn't think that they were going to get their deals done. So I am going to turn it over to Paul Shaughnessy. Normally, if we were in a meeting, everybody would be clapping, so I'm going to clap. Before I hand it over to Paul, I want to make sure that everybody has a very Merry Christmas. I'm festive today, so I'm heading where it's warm tomorrow morning. I'm excited about that, but I hope everyone has an amazing holiday season and a happy new year. And take action in the new year. Don't let what has been going on in our country stop you from doing what you need to do for yourself and for your family. So I'm going to mute myself. Take it away, Paul. If you need any help from me, I'm here, and I'll be monitoring the chat. If people have any questions, they can just put it in the chat. Okay.
Perfect. Thank you, Bernadette. I really appreciate it. And thanks everybody for joining Bernadette, myself, and everybody else on the Zoom call on this Thursday evening. Truly appreciate it. Looking forward to really sharing a lot in relation to Renovo in general, and just kind of, sharing some education and some information about what it is that we do and who we are as well, and how we can help real estate investors statewide and accomplishing their goals. And I think you'll find that you probably will definitely receive some useful information tonight. Now it's up to you on however you use it, but I'm here to give it to you. So maybe I think, I don't want to bore you with like a huge background story on who Renovo is, but I'll give you a quick high level. And I'm also going to share my screen to start. I have a little PDF deck that I put together for this. So I'm going to go ahead and share and we'll get started. So I'm sure many of you on the call actually, unless I've maybe possibly worked with you in the past, you may not have heard of Renovo, and there are obviously obvious reasons behind that. So Renovo Financial has been around for about 10 years and founded by Kevin Werner, who and Daniel Rosen, who are both Chicago natives. So we've primarily over the last decade been focused on the Chicagoland area, and what we focus on is building relationships, true, genuine relationships with real estate investors statewide, well, in our local markets, and we help them grow their business. So, and it's generally through financing their real estate projects, whether it's rehab, rental, or new construction. And I think you'll find that this is just a little award recognition type slide, but I think what you'll find is that we do things a little bit differently than a traditional hard money lender, because we truly care about the story and of a lot of investors we work with. So if there's something that comes out of this for anybody on this Zoom call right now, I think you'll find that we're gonna have pretty lengthy discussions about your story, how you got in the business, what your current business looks like, and what your future goals are. And we try to come up with a game plan of attack on, hey, are we actually a fit for you? And are you actually a fit for us? And, I think it's very important, and it speaks to character, and we uncover, like, is there really a personality fit here outside of just us funding loans? And is this just a transactional relationship, or is it a true, genuine relationship where we can call and call each other and wish each other happy holidays and actually have a true friendship outside of just business? But just some high level statistics, about what we've done over the last decade. So we've funded, we're in our 10th year, over 2,500 loans. We're actually probably, I think, a little over $1 billion at this point in originations. And we, in 2019 alone in Chicago and in Texas as well, we did about 600 projects. There's actually about 20 of those were in Massachusetts, because we were testing the market prior to actually getting boots on the ground here. And as of right now, we are the largest rehab lender in Chicago, 4 years running, and we plan to do that in each of the 5 markets that we're in currently, Boston being one of them.
I just want to point out that just because Renovo is based out of Chicago, Paul is in Massachusetts.
I should actually mention that. Yeah, thank you for that. So I'm actually a Malden native. So I was born and raised in Malden. My parents actually still live there. And I've spent the vast majority of my life in Massachusetts, and have been in this business for just under 5 years now. And funded in Massachusetts, I've probably funded about $50 to $60 million in origination. So I've done quite a bit, I've done quite a bit with Bernadette as well. We have a very strong working relationship. And I think from a value standpoint, and I don't really like to pitch features and benefits. I think it's really more about you as an investor, rather than us trying to talk about, hey, how greater we are. That's not really what I'm here to do. But I think it is important to understand, what our, I guess, value proposition is. And I think the biggest thing, and that's number one on this list, is really having direct access to decision makers. So, and that's myself. So I'm the guy in Boston who has boots on the ground. So the deal is presented to me. I do a pretty deep dive as far as an analysis goes. And if the deal makes sense, we're going to fund it, right? So we make very strong commitments, and we're true to our word. And that's one thing that I really want to preach on this, is that, if we look at a deal, yes, it needs to ultimately get approved by committee, but all the decisions are typically made by the actual lender in the market, and that would be myself. And with that comes, deeper local knowledge, being that I was, raised in the area, and I know many neighborhoods across the state, and familiarity with a lot of those areas. And the third thing I think is probably the biggest reason why we hear that people want to search for a new lender is speed, and that either comes down to draws or actual closing timeframes. We've heard from a number of investors that have come to us and worked with us that, something came up where the national lender goes through an appraisal management company, which outsources it all to appraisers locally in the area, but some may not have local knowledge of that specific neighborhood. So, and that isn't necessarily chosen by local knowledge. It's chosen by, hey, how quickly can you get this appraisal back, right? So I think there's some inefficiencies from what we hear in that process, and it ultimately causes delays from what we hear from a lot of our investors we work with. Because when an appraiser is chosen through an AMC, it goes through, now we have two different parties removed from the investor. So we have the AMC, now we have the lender, and it trickles down to the investor. So it's a constant, oftentimes it's just a delayed process getting the appraisals back. And now when you talk about fund control, a similar situation happens from what we hear. And what typically happens is the big national lenders will keep them nameless. They offload a lot of their loans and require a third-party inspection company to manage their fund control. And that's actually a protection piece for the lender, right? And also the borrower in a way, because you never want them to run out of funds throughout the project. But oftentimes we hear that because a third party's involved, it takes quite a while for borrowers to receive the reimbursement. So it can take 1 to 2 weeks. And the people that I talk to, they're extremely frustrated with that entire process. And it can hold up the projects and also cause, which if it holds up the projects, could cause tension with some of the contractors on the site. I've even heard stories where contractors have walked off the job because they weren't paid on time. And that ultimately trickles down to the lender's process if it's not efficient enough. And then I guess a fourth value add is really the true genuine relationship. I can name a number of different stories where the investors we work with, we try to add value to one another, whether it's them referring us to other investors or it's us referring them to other reputable contractors, other real estate brokers in the area who have done, who have a great reputation of selling condos over asking or single family homes over asking or getting things leased up in a timely manner and at market rent requests, right? So there's different kind of value adds that I think we have, and we call that our circle of success. So we really try to align ourselves with other people who are experts in the local market, like a Bernadette and others around the state that really have that ability to help you bring your business to the next level. I think it's extremely important, because I think there's misconceptions in the industry now and how it's evolved as far as the lending side goes, is you really have, it's become almost transactional, right? So somebody goes to a big boxy nameless national lender where they request a loan. There's usually 3 questions they ask, right? It's mainly, what are the details of the project, whether it's purchase, rehab, right? All the details of the actual project. What's your FICO score? How many deals have you done in the last 3 years, right? Those are the main questions that are asked. But has a lender ever really sat down with you and understood, hey, where do you come from? What's your story, right? How did you get in the business? Why you're in the business? What drives you, right? I think there's more to say than just, let me give you money just because you have a project. And I think that's very important. I think when you have a good working relationship with a true partner in your business, and that's what a lender should be, is a true partner, because think about it this way. If a lender just issues loans, they don't provide other value, does the lender have certainty that the borrower is going to continue to utilize them as their lender? No, because you're not providing value outside of just money, right? And I think there's more to say to that. And if you are doing that, you also improve the chances that your investor is going to get to that next level, right? And what happens when that investor gets to that next level? It benefits everybody, right? So I think there's a lot to say about that, but I'll leave the value piece there. I don't want to, again, I'm not here to pitch features and benefits, really more so education than anything else. But I think I touched high level on the leadership where Kevin and Daniel Rosen had formed Renovo 10 years ago. I think this slide is really just to show you that all decisions are made in house. These are all the decision makers ultimately at the end of the day. So once we approve a loan, these are the guys that make all the magic happen. Next slide here, really talking about the technology approach, because I touched on the draw process. So again, what we hear from a lot of people is that draw processes can go on for quite a while, and we try to listen to a lot of what investors, say to us, and what we hear and what we've heard over the years is that, delays can cause a lot of friction on projects. It also increases your costs and decreases your profit, right? So we want to make sure that our processes are as efficient and streamlined as possible. And how is that done? So one way is through expedited draws. So we have a proprietary technology on top of our CRM that we spend quite a bit of money on that allows us to release draws as soon as the same day. So we basically will FaceTime our fund control manager from the projects through our technology, and he takes still shots and authorizes reimbursement right then and there. Or maybe there's another document or two we got to collect before we actually issue the reimbursement. So absolute worst case scenario may be a day or two after the inspection. So you're looking, rather than waiting 1 to 2 weeks from what we typically hear, you're talking 1 to 3 days from request to money in your bank account. So I think from a holding cost standpoint, that dramatically improves the cost, the profit margin in your deal. Because if you think about it this way, and these are actually, so I think the first question I always get from investors, hey, what's your rate? Right? That's naturally the first question you're going to ask. And I always tell people, look, you're always, no matter where you go, you're always going to be able to find a cheaper lender anywhere, because what's happening in the industry is everybody's just undercutting one another. So it's like, hey, I can do a quarter point better. I can do a quarter point better. So no matter what, you're going to find a cheaper deal. And 90+% of what every lender does in the industry is the same. It's really the 10%, the small little intricacies of the loan that truly matter. And I think draws are one of them. It's a major component as to how the project is executed upon. But what I'm getting at is if we just take simple numbers here. So if we have a borrower who comes to Renovo and they're quoted an 899 rate, but they go to a larger boxy national lender and they're quoted a 799 rate. That's a 1% difference. But if that national lender takes 1 to 2 weeks to reimburse their draws and it stalls the project, times that by 4 to 6 draws on average per project, your costs are actually probably far above that 1% that you're looking to save on the front end. So that's why I think it's extremely important for any investor to dig deep into whoever they ultimately decide to work with. Might be Renovo, might be somebody else. And whoever they decide to work with, they really need to dig super deep and understanding, like, hey, how do your draws actually work? How's your servicing? Are you actually going to give me a payoff the same day I request it? Or are you going to give me a payoff 2 weeks down the road after I was already supposed to close? And now the buyer's a little upset and they might walk from the deal, right? So that all these little things can jeopardize your business, and that's the last thing you want. But I'll leave that there as far as the technological approach and the draw piece. And that kind of leads up to, I guess, who we typically work with. So there's a number of different types of people which are listed here who we generally work with. So whether you're a high volume production rehabber who does 50 to 100 projects a year, where we have premier lines of credit for, or it's a portfolio builder, so you have the BRRRR method in mind, and we have options for both short-term and long-term. So if you're looking to rehab a distressed asset, stabilize it, refinance into a long-term 30-year fixed, but maybe you've done 1 to 2, maybe 1 to 5 projects a year, you can't show consistent income, you have great profit on your projects, but you can't show consistent income, so you might not qualify for a bank loan. So we're the guys that can help with a hard money 30-year fixed loan where the rates are as low as 5%. So the numbers could still work, especially if you're in like the Gardner area or or Worcester or Springfield or New Bedford, Somerset, and in and around the outside of the 495 belt typically. But so I think that's important to note. Different strategic investors, whether you're looking to flip and hold, you have a hybrid model. Part-time investors, I work with many. So there's plenty of investors that I work with that are W-2 employees, have great income, do extremely well for themselves, but they ultimately want to get into real estate and transition full-time later on. And we want to help those people get to that place where they can actually pursue this full-time, walk away from their W-2 job, where they can create and sustain their own career and build their own income for themselves, and ultimately create a legacy for family and generations to come. And the list kind of
quickly on the
Sure.
on the BRRRR method, and for people who don't know what BRRRR is, buy, rehab, refinance, repeat. Is it, if someone wants to incorporate that, is it just a quick refinance, or how does that work? Are you going to go over that? Sorry, am I asking questions too soon?
No, it's a great question. So yeah, so when they get into a flip loan, we would underwrite it as if we would ask for their exit strategy on day one. And if they determine, yes, they think they're going to refinance this, as part of the initial inspection, we'll get a market rent analysis as well. And upon completion of the repairs, we would get another gut check of value. And once value is determined, we would go and proceed with the refinance into that rental loan. But we would underwrite it on the front end of the rehab to make sure that, hey, subject to values being where they're underwritten now, and the market hasn't taken any sort of correction, which we all know it's booming right now due to rates and a variety of other reasons, then yes, it would be a simple refinance, as long as, again, values hold true, and I guess secondary to that, the borrower's financial picture hasn't changed dramatically. Does that answer the question? Cool, great. And I think we haven't really touched much on product diversification. I'm sure there's a number of questions people have as far as rates, LTVs, origination fees, all that fun stuff. But one thing that we look to accomplish is really being a one-stop shop for investors and allowing you to scale over time. So we find that there's a progression over the course of an investor's career. Typically, they get in. What we see is some people start off wholesaling, right? So you get in the wholesale business, build up enough cash to do a flip. Flips build enough cash to sustain that flip business, and to also start purchasing cash flowing rental property, whether that's the BRRRR method again, or if it's something where there's turnkey rental because they're getting it at such a good buy. So we have the ability to really allow, and I guess the actual progression after that is probably multifamily ground construction. So there's a number of different kind of scalable approaches that we take in order for investors to stay in one house and not have to shop to a new lender on every deal, because let's be honest, paperwork isn't everybody's favorite. And I'm sure that you really don't want to have your credit pulled 100 times and shopping for the right lender. So we're fully aware of that. So we try to really prepare ourselves for that and set you up for future successes as an investor later on. So and I think this is an important piece of us actually learning about what your goals are later on as well, is to see how can we actually help you progress to that next phase in your real estate career. So some of our offerings, everything you really need to know is here, outside of, again, those smaller intricacies. But for our residential short-term bridge product, it's either rehab, new construction, or acquisition. Our terms can range anywhere between 6 and 18 months. You'll see 8 to 11 on rate, so it's pretty. I guess I'd like to actually touch on that. So in Massachusetts, I'm sure a lot of people are aware of this, there's really 3 main buckets of money. So bucket A is bank money, right? Hard money is never there to compete with banks. I think it's every investor's intention to ultimately get to the point where they can work with banks. And for obvious reasons, right? They do require a little bit more down, but you're in that phase of your career where you have a bunch of cash laying around, and you're able to sustain the business, and you can put heavier down payments down because of that, and ultimately you get a much cheaper rate, right? Where that's, I think Renovo is really, and Renovo and any other hard money lender is really for those investors who qualify for bank money. You're that situational lender. So maybe it's that quick bridge loan that you need in order to go through zoning or permitting, in order to get a ground up deal shovel ready, right? So there's different, or tiered on a rebuild shovel ready. So there's different kind of reasons why we would work with borrowers who qualify for bank money. But then there's bucket B, and bucket B, I think, is really that local lender, where their convenience is tenfold. Like it's really hard to match because they maybe don't require appraisals, and it's BPOs, or draws are done again in-house, servicing's in-house. But usually in any world you pay for a premium service like that, right? So these localized lenders, and again, they were nameless, but they're 11 to 13% rate. Maybe they'll go up to 90% on purchase and 100% of construction, and their origination fee is 2 to 3%. So it's expensive, and certain projects just might not work with that product. So you have your third kind of bucket. So bucket C is your national lender, where it's again pretty boxy because they have to underwrite to a specific criteria, and if you don't fit the box, might not work. But you have other options out there, of course. But if it doesn't fit the box, might not work. And if it does, those loans again are offloaded. You have third-party servicing, third-party fund control. But their biggest value proposition there is you have rates as low as 8%. So it makes projects that might not be viable with a local lender much more viable with a national lender. Now, the way that I like to describe Renovo, I don't think we really fall in any one of these buckets. The biggest difference maker is we consider ourselves a local lender because we take that local approach. We don't use AMCs. Servicing is all done in-house. Fund control, again, in-house. And we have the ability to compete on price with the national lender. Now, one thing we always tell people is we don't like to win on price, but we don't like to lose on price either, because I think there are different value adds that you'll find are much more valuable than a quarter of a point or a half a point, or even in some occasions a full percent. I've heard stories of people who have worked with a national lender in the past, and they're getting 8% and 1% origination, but it was just such a nightmare for them that they were just like, I'm paying 12 and 2 to my local guy because it's convenient and I don't want to deal with the headaches. So I think there's something to be said about that, but ultimately it's up to whatever goals the investor has. But this is really our product suite, and I'll be sure to email Bernadette this PowerPoint, and she can kick it off to everybody that's actually on the Zoom call, listening and hanging tight, and I hope you guys are enjoying it so far. But so that's
I do have a question. A lot of times investors ask if points can be rolled into the loan. Is it really on a loan by loan situation, or is that something that you guys offer on all loans?
Yeah, so it is loan by loan, because we ultimately, just like any other lender, have a maximum loan to after peer value kind of threshold, and we don't want to cross that threshold. So as long as the property, the values make sense and the loan makes sense in comparison to the after peer value, then yes, there'd be room for both an interest carry as well as the origination fee to be rolled in. So in some occasions, investors are only putting down 10% of cost.
Okay. And if anybody has any questions throughout everything that Paul's talking about, just put it in the chat, or there's a Q&A thing too, but you can put it in the chat and I'll make sure that I ask for you. Okay, go ahead.
Great. So this leads to case studies. These are, because I didn't have time to put together any Boston specific ones, I just didn't have time to pull photos and everything, so I apologize, but these were already put together for us. These are really Chicago specific case studies that talk through multifamily projects and the types of loans that it shows, kind of the different flexibilities that we have as as a lender. I think someone just posted in the chat. But yeah, so I don't know if I'm going to dig too deep into these. I might just leave these on the PowerPoint and send these over to Bernadette. I actually have some scenarios that I can draw up on the board behind me. I'm hoping that you guys can see the board. I think there's a glare at the top. That's what Bernadette and I identified when I was writing up earlier testing this out. But I think it's important to maybe run through a couple of unique scenarios that we were able to take on in recent weeks, actually. One specifically was in South Boston, but I'd like to talk through these real quickly here. So I'm going to jump up on the board.
For folks who want to get in touch with Paul, for the people who are attending, I'll make sure that Paul's able to reach out to you, and we'll share his information.
Great.
Okay.
So I'm going to draw up one specific scenario just to show kind of maybe the flexibility of the money, and I think it's one that's it was in South Boston, and the investor. I may have not even need to necessarily draw this up, but an investor was purchasing a 2-family home in South Boston, and I think we all know, if anybody knows how difficult the South Boston market can be as far as zoning, rezoning, and permitting goes, it can be extremely complex. And the investor needed about 3 to 4 months in order to finalize this process. He was already in process for this while he was entering his purchase contract. But so we don't want to close on the deal if he doesn't have zoning and permitting ready, because the second he closes, what happens? The time starts. So you usually have 12, maybe 18 months to complete these, right? So in this scenario, he's looking for a 12-month term from the date of construction to the point he's going to sell. He thinks he's unloading these in maybe 9 or 10 months. Right, this is $1 million acquisition for an existing 2-family home in South Boston that needed to be rezoned for it to be torn down, and the borrower was going to rebuild a 4-unit condominium complex. And again, this is something that can be really complex in the city of Boston. So in some occasions, it can take up to a year to get zoning approvals done. So luckily, it took him less than 6 months. So the goal was the seller was getting antsy. He says, "Hey, I'm sorry, I can't wait any longer. I've got to close on this deal." So he thinks he needed 3 or 4 months left in order to go through rezoning. So we decided to offer the borrower an 80% bridge loan, which is a purchase-only loan, no construction money attached to it. But so on $1 million purchase, he's putting down $200,000. And usually on a ground-up construction loan or a tear-down and rebuild, lenders would cap at 90% of total cost on the project. And of course, a tear down and rebuild of 4 units is probably, I think the build out was about $1.3 million. So our loan to cost threshold, if we do, actually, I probably need to draw this up to show the differences. So if we're at,
Paul, stop sharing your screen so we can actually see you.
Okay, great.
Awesome.
Okay. You see me?
Yes.
All right, can you see that on the board?
Yes, I can.
Okay, hopefully everybody else can too. So in this case, again, it was $1 million purchase price. If we're offering 80% on the acquisition, we have an $800,000 initial loan. It's also called, again, a bridge loan. So this is acquisition only. Now, most lenders, if we have a $1 million purchase and the rehab or construction, of this was $1.3 million, our all-in cost is $2.3 million. So most lenders, when they underwrite a construction deal, cap at, some are more conservative at 75% of total cost, some do 80%, some do 85%. So I'll just show the highest loan to cost of 85%. So if we're at 2.3 million times 85% of total cost, our gross loan in this occasion with with this lender B, we'll just name us Renovo here. And then lender B is over here. So in this case, our total loan, if we're at $1 million plus $1.3 million for construction, we're $2.3 million all in. We're at 85% of total cost, which is $1,955,000. Right. So if we take out our $1.3 million for construction, we get about 1.6, I think. What? I can't do simple math right now. It's been a long day. Sorry, guys. So we'll take out the construction because they're always going to finance 100% of that construction money, right? So we'll take that out, and we're at an initial loan of $655,000. So that requires the borrower to put a hell of a lot more money down on the deal than if you were to do it this way. In Renovo way, if we're offering an 80% bridge loan, when we offer this 80% bridge loan, we're going to underwrite the deal as if he's tearing it down and rebuilding it, so that when it comes time for him to actually get his construction money, we don't have to offer him a full-on refinance where he has to repay the origination fee, start his clock all over again. All we have to do is issue what's called a loan modification. So I think this is extremely important to understand, especially if you have difficult loan scenarios like this one, where you need access time and ample time in order to get through all the approval processes to where you have the ability to then execute on your construction. So the clock then starts after we issue this loan modification, where we give the borrower another 12 months to complete his project. So if we give him a 6-month bridge loan off the gate, and he thinks that zoning is going to take 3 months, but it might take 5 months, he still has the ability to get this loan modification, increase his loan amount so that he can actually get the construction money by another $150,000 versus lender B. And it gives him the additional 12 months to be able to take on this deal with ample time, not be stressed out, not feel like his back's against the wall, he's racing against the clock, right? So I think that's something that's extremely important. And another piece I'd like to add too, in a scenario like this deal, I think we underwrote the deal at, I think it was 60 or 65% LTARV. So that means our loan amount appraised at 60% of the after repair value. Well, we cap at 70% of the after repair value. So what does that leave us with? It leaves us with a 10% cushion, so we can finance interest, so we can finance the origination fee, right? So that's something that's extremely important. So not only do we give them the flexibility to be able to sign on that dotted line for the loan modification and get that $1.3 million so he can start the clock once he's ready to break ground. We also allow the borrower to we give the borrower the ability to not have to make payments throughout the course of the project. So I think that's extremely important to understand the power of like flexibility with this type of money. But that was this scenario. I think that's probably the most creative that I've done to date. Otherwise, a lot have been pretty similar, a lot more simplistic fix and flip deals where we finance 85 or 88% of the purchase, 100% of construction, and
Okay. So Eric wants to know, how does a buy and hold investor work with you?
Sure. So a buy and hold investor, the product isn't extremely complicated for the 30-year fixed program. That one we go up to 75% LTV. Now I know there's some programs out there that you can get 80%, but we go to 75, and there are different kind of variables that push and pull against one another to ultimately determine loan to value, the max loan to value we're willing to offer, the interest rate and origination fee. So, and those variables are typically your DSCR, which is comprised of, it's really, do your expenses, does your rent payments actually eclipse your all-in expenses for the property, which all in to us and the DSCR situation is really your taxes and insurance and principal and interest payments. So as long as that exceeds 1 to 1, then we have we were able to make an offer, and as long as the borrower's FICO score is in excess of 680, that also qualifies. But I have had exceptions made where borrowers' FICOs were less than 680. They're just different. They're different compensating factors, if you will. It's a common sense approach.
Okay. The next question, well, there's a couple of questions. Okay, so I recently had an opportunity to purchase an off-market property in Framingham for $350. The house was dated but livable. I could have listed the house as is for $420, $435 without doing any renovations. The house went under agreement within a week for $435K. Would Renovo finance all the money on this property total and share in the profits with regular fees?
We wouldn't necessarily finance the entire purchase price, regardless of how good of a deal you're getting. There's reasons behind that, and mainly because we want, like Bernadette mentioned in the beginning of the call, we want skin in the game. I want to have some sort of alignment between us and the investor. We believe that alignment actually builds upon relationships, and we can both stay committed to the deal and making sure that we both execute on both sides. So although it could have been relisted instantaneously and you could have made a nice little profit, we still want some skin in the game. But good thing to note is that we don't have a prepayment penalty or a minimum number of months for interest. So you could have bought and sold that thing without having to pay us anything in excess of whatever your daily interest was at the time, and your closing costs for title and escrow and the origination fee. So.
Okay. And then Kevin says, do you fund any soft costs like in that South Boston condo example, like architect, legal fees, etc., to get permits approved?
It really depends. So that's a pretty loaded question. I think, in this specific scenario, it was he already started the process, and he had a lot of that already drawn up, so we didn't necessarily need to do that, nor did he ask for reimbursement for it. But yeah, I mean, we definitely do get flexible with soft costs, and it is a possibility.
Do you, now this is a me question, just because I get a lot of GCs who come to me and they say, look, I'm tired of the rehabber making all of the money, but I don't know how to make the move so that that I can work with them. How do you work with the GCs to help them turn into the rehabber that's making the bulk of the profit? They can obviously fix the property themselves with their crews and save on cost where that's concerned. But how do you work with those type of people?
Sure. So I've worked with a number of we call them first-time investors, but in all reality, I know a lot of construction, a lot of general contractors who have a hell of a lot more experience than some investors, because there are some investors who have W-2 jobs and they just have good liquidity. And maybe some GCs just don't have the right guidance to get to that point to take down their own projects. I've worked with a number of general contractors who have significant amounts of construction experience and are looking to become an investor and get in that seat. I think the biggest thing on the Renovo end is just to make sure that there is some liquidity available to, put skin in the game. That's probably the biggest thing for us. Otherwise, I enjoy actually working closely with a lot of first-time investors, because I like seeing the progression over the years. Like, there are some first-time investors who I'm close friends with nowadays, and seeing them profit 150 grand in their first flip is extremely exciting to me. Like, I actually have a high school friend who was a GC and actually not GC, he was actually in construction. And he was also on the real estate side. I lent him money on his first project, and he was off to the races from there. And now he does a handful of projects a year. So it's pretty exciting stuff to see that.
Awesome. Okay, we've got a lot of little questions. So I'm on the website right now. Can Paul talk about the rental property loans program? Thank you.
Sure. So the rental property loan, again, it's driven off of FICO, DSCR, and that's
What is
probably
that?
DSCR, debt service coverage ratio. So basically what a DSCR calculation is do your mortgage rents that you get on a monthly basis on the property eclipse or either reach or eclipse your mortgage payment or all in expenses. And to us, what goes into a DSCR calculation are principal and interest payments for the actual loan, taxes, and insurance. Now we do account for potential vacancies as well throughout the course of your loan, but there's a number of different kind of expenses that play a nominal role on top of that. But usually the calculation works out to just looking at principal and interest, mortgage payments, taxes, and insurance.
Okay. Eric says, am I correct that you seem to prefer doing short-term lending?
No, I do plenty of term loans. The majority of the when I say term, I mean 30-year fixed. So the majority of the longer term loans I do just they're not in and around like the immediate Boston area. A lot of them are in New Bedford, they're in Springfield, they're in Gardner. So like those are the areas where we typically see that properties cash flow well. Not so much in and around the Boston area. It also depends on how much down payment you're putting down on the asset. Of course, if you have $1 million laying around and you want to invest in a handful of assets and spread it across, then you can potentially do that, around the Boston area and invest in a couple of multifamily deals. But oftentimes they don't cash flow as strong as you'd like.
So the next question is a follow-up to one of the original questions asked. You want us to have skin in the game, which makes sense. Could that also be in the form of equity versus cash?
Equity versus cash. So we're referring to if you get basically a deal significantly under market value, we would still like to have hard skin in the game. So we would like to have cash in the game.
Okay.
Now that could very well likely come from an investor, right? So there are plenty of, and Keaton's going to talk about that on the next meetup, but there could very well likely be other investors out there who are willing to, provide that gap money. And we do work with gap lenders and do allow seconds. But the thing for us is we want to know who they actually are, and they'd obviously have to sign the subordination agreement.
Okay. How hard is it to get the LOC from your firm? I assume it will be commercial LOC. And are you backed by banks or private equity?
So I'll answer the second question first. We're backed by, we actually have different buckets of money internally, but our primary funding partner is a private equity group. But if you take a look at the website, you'll actually see who they are. It's Granite Creek Capital Partners. They're actually in 2 doors down from our headquartered office. The first question was, I'm sorry, what was the first question?
It says, how hard to get the LOC from your firm? I assume it will be commercial LOC.
I think they're referring to line of credit, and it's not difficult to get the line of credit. We do underwrite financials when it comes to that, and we look at those a little more closely because we try to take a look at, hey, how heavy is the debt versus the income? And we don't necessarily dig into income, don't get me wrong. We've seen investors, you try to write off as much as you can to get to as close to zero as possible, and we're fully aware of that. This is very common sense underwriting, but in real world underwriting at that. But it's not complicated. We just, with the line of credit borrower, want to make sure that you're doing projects that are of similar size. So if you have $150,000 flip, but the next one's $1.2 million, then that's probably not a good line of credit client, right? We want to make sure that whoever's doing line of credit has, a consistent business model of projects that are what we consider like for like.
Okay. All right. So what else were you going to talk about? I've been kind of interjecting with all these questions and stuff.
Yeah. Eric just asked another one asking how reliable are our funding sources. Well, they're a 50%
Oh,
partner in the
yeah.
business. So they own half the business. So that's, we lent through, I guess a follow-up comment to that is that we've lent throughout the entire pandemic. So we never stopped lending. So I think that probably says a lot.
Mm-hmm. Mm-hmm.
Yeah, but
That's probably one of the things. Can you explain to people the biggest difference between having and working with a company that is backed by private equity versus backed by banks, and talk a little bit about the process?
mhm. Yeah, so um, there are actually a number of lenders that are backed by private equity, and I think what matters most. Are we talking? Just so I'm clear, Bernard, are we talking about reliability? Okay, cool. So when
And
it comes
being
down,
able to fund in some stuff. And Eric is wanting to know the best way to reach out. We have some business to talk about. I have everybody's email when they registered, so I will make an individual connection and make sure that Paul has everybody who is attending's information.
great,
Okay, so go ahead.
cool. So were you referring to working? Can you restate the question? I'm sorry, Bernard.
Just the difference between working with a company that's backed by private versus a company that's backed by banks, and what I know you talked a little bit about the process, but what that does as far as it's other things happen, not just the pandemic.
Mhm.
There are other things that happen in the banking industry that can cause issues. What's the big difference, and why is it different?
Totally. So with private equity, you have your own money and truly have your own money, right? And you have and usually the private equity partners they have some ownership or a significant ownership in a firm. So they're really in it for the long haul versus when you have somebody backed by banks aren't typically ownership. They don't usually have an ownership stake in a business. It's usually a third party relationship. So what happens is, and what happened actually when the pandemic hit was there are a number of national lenders that are backed by Wall Street, right? And Wall Street has a number of different lines of credits, and they have relationships with big banks. And when you're backed by banks, if you will, like that third party relationship where that bank or that hedge fund who has relationships with those banks in multiple lines of credit, they put together a box of criteria for a loan, right? So that's why when you work with a national lender, they ask, what's your FICO score? How many projects have you done? Where's the asset located? What zip code is it in? Because they run all these different algorithms on the back end and say, okay, based on this box, it'll fit in this box. And what happens is they offload those loans to these bigger Wall Street firms and other, who are securitized against other bigger banks and all that fun stuff. It can get extremely complex on that side. But, when the pandemic hit, what happened, and this can happen, in other scenarios, is they issued what's called a margin call, because all of these banks, they have criteria and they have relationships with they have what's called a mortgage loan purchase sale agreement with all of these bigger banks, and they secure this stuff. They sell commercial mortgage-backed securities. I'm getting into way too many finer details, but a margin call basically says, hey, Mr. Hedge Fund, you sold the bank all these loans at 100% of value. Now, based on all of our algorithms that we have running on the back end, this commercial mortgage-backed security is now valued at 70 cents on the dollar. So you got to clear that difference. And that's a 30% difference. And we're talking about these hedge funds are buying hundreds of millions of dollars of loans. So 30% difference on hundreds of millions of dollars is tens of millions, hundreds of millions of dollars. So you have to clear those margin calls. And usually within 48 hours. And no one has liquidity to be able to do that because let's be honest, America revolves on velocity of debt and velocity of capital. It's just constantly flowing throughout the economy. That's how our entire machine has been built. And so that's a trickle down effect to the actual originator who's backed by these banks, right? So these guys basically can't originate loans anymore because they can't sell the loans to Wall Street because Wall Street couldn't clear their margin calls on time to the big banks. So that's what happened when the pandemic hit, and that could happen any sort of catastrophic event worldwide. It could impact financial markets in any way. And I think being backed by a private equity group who sees opportunity when things like this happen, you have certainty of funding, reliability, and again, I'll say it again, a true partner in the business. We're in it for the long haul. I hope that answers the question. I hope it made sense.
I was muted. I think so, yes. Yeah, I know that there was a lot of people scrambling when everything happened. So I just want to make sure people understand that's definitely a question that they need to ask regardless. I mean, obviously, you're speaking at a Boston RIA event and we've worked together for a long time. So, I just want to make sure people, if they're out and they're shopping and they're talking, that's one of the questions that they ask, because you never know what's going to happen over the next year. You need to make sure that you have a lender who's able to lend regardless of, some of the bank situations that might have happened, or the pandemic, or any of the other things that happen. So I know it's definitely questions that I ask when I talk, and I get, just so people know, I get lenders reach out to me on the daily asking me if I can refer my people to them. And, I don't know. I don't just refer any lender out to people because I don't know, but I do have history with Paul. So, is there anything else that you wanted to talk about? And on that point, is there anything else, any other questions that people have before we say goodnight and Merry Christmas, and we'll see you next month?
Yeah, I think on my side, I think I've touched on quite a bit. I don't know if I have that much more to discuss. I think I'd love to speak with whoever would like to talk over the phone or meet for a coffee or beer, whatever you're into. But I'm definitely interested in speaking to everybody on the call, and I'd love to have a conversation to see how I can benefit.
Yeah. Yeah, Brianna, I will, Paul will get me the PowerPoint, and I will make sure that I share the PowerPoint with the people who attended this evening. And then Flory said, you talked about what if you don't have capital? Is there a way to help to create that capital?
Yep. Yeah. So Bernadette you'd mentioned that in the beginning of the call that you're going to have a follow-up meetup event with Keaton, and I've actually, so Bernadette introduced me to Keaton 2 years ago now, and we've done a few projects together actually, and he is an expert when it comes to raising capital and working closely with investors and updating them along the way. He has a great business model.
Mm-hmm. Yeah, so he will be our speaker next week, and not next week, but next month. So I'll make sure that I put that information out. And Flory, we can also talk separately, because I have lots of people with money. So is there any other questions before we jump off and let people go for the evening? No, thank you. Okay, so everybody said thank you, and we appreciate it. And there are groups of people I'm gonna send you. Thank you, Eustace. Eustace said, good stuff, Bernadette. I'm gonna make sure that I make connections with the people. I'll probably, what I'll do is I'll just send you the list of attendees and registrants so that you can reach out to, people. And I encourage that everybody, you know, whether, I mean, I don't know what we're allowed to do anymore, what people are allowed to do in Massachusetts. I don't know if the bars are open or if coffee places are open. I have no idea. But I definitely recommend a sit down, you know, buy Paul a cup of coffee, and he's a wealth of knowledge and can certainly help everybody. So thank you so much, everyone, for joining us. And thank you, Paul, for, you know, sharing, you know, your knowledge and what you do with Renovo. And everybody that's coming through is saying, looking forward to connecting with Paul. So they'll welcome your email. Okay.
Great.
All right,
Thank you all
guys.
so much.
Thank you. Have a great night and Merry Christmas, everyone.
Thank you, Bernadette.
Okay. Bye, guys.
Talk to you soon.